This is a review of the major asset classes for the week ending July 29th. And so far as we can discern from the charts that went final on Friday, a look ahead at what might happen for the week beginning August 1st. And we'll start with the Iwm the Russell 2000. And the Russell 2000 is at the top of the trading range, but we can see if we zoom in that the 9-day range indicator is still heading up, as is the 26-day range indicator heading up or drifting upwards slowly. So because the top of the range is an undesirable long trade position from our perspective at least, our look ahead for the week would be that we don't really want to be going long here, but the breadth indications are so strong that we probably would not want to be going short either. I think we need a shakeout in this index from our perspective before we would want to take a position. But I just want to show you one thing on the front page here, and then we're going to take a look inside what's available on the front page and maybe get some greater insight into what might be happening with the major indexes. On the right hand side we have a volume spread analysis panel, and these green and red bars are cumulative volume, and they're based on whether the underlying has had a higher high or higher close in successive days, in which case all the volume would be accumulated or added together, and you get these progressions of green or red bars. And well, the red bars occur for lower low or lower close. The Chaikin oscillator is a rapid response volume and price indicator, and the accumulation distribution indicator uses highs, lows, and closes and volume to indicate whether the underlying is being accumulated or distributed on a longer term. And we can see that the rapid response Chaikin oscillator has flattened out and that the accumulation distribution is heading up. But that may not be the entire story, and we can take a look behind by looking at the Wyckoff tape reader chart. And if we just do a little bit of housekeeping, we can see that the last several days in the IWM, and this holds true for the other indexes as well, have been distribution days. Now, the way this information is gathered is that we sample each daily bar at 5-minute intervals throughout the day using price and volume, which we then net out at the end of the day. Now, usually when a bar closes up, you get a green volume bar, and the volume is added to the accumulation panel as it is over here. But when you look at the volume and price every 5 minutes, you can get a different story. And the red numbers with the negative in front of them, or the minus sign, indicate that the net effect for this bar, when we sample it 78 times during the day, is that distribution was taking place. And we can see that there are several up bars that would appear green on a standard volume chart, but are actually distribution days. Now, it's an ETF, and I don't think that's as completely reliable as it would be for an individual stock or a futures contract, because often the index ETFs are used for hedging purposes and not necessarily for investment purposes. But I think the fact that there are so many distribution bars in this sideways movement suggests that we exercise caution. The candlestick trader and the breakout bands trader indicate to be holding along IWM or the other major indexes if you have these ETFs in your portfolio. I think, but you want to keep your stops close, maybe a 1 or even a 2-day stop. Certainly a candle signal, a candle sell signal below the 8-day EMA would be an indication to sell and take profits, which you should have by this time, certainly on the major indexes. So our look ahead for the week beginning August 1st would be to expect more of the same, or a continuation of the upward drift. We would not anticipate a big breakout from this level, although that could occur. We would not be participants if it did, because I think that the risk with the major indexes is to the upside. Now the next one we're going to look at is gold, and this is the Spider Gold Trust. And for last week it was sitting pretty much in the mid-range, and we anticipated that we could get an up week in gold, which is in fact what happened. And we can see that the 26-day range indicator is fairly flat, but the 9-day is heading up. The Chaikin oscillator is heading up. Volume spread analysis is indicating the stock is under accumulation, and that's confirmed with the accumulation distribution indicator. So we would hold long gold, but the upside is probably limited. From this point, with the information we have as of Friday, would not be anticipating a huge upward movement in gold for the week, although we would expect that the drift will continue upwards. And the outlook is similar for the 20-year Treasury bond, which is in a very similar situation. In our forecast or outlook for last Friday was the same as for gold. We anticipated an upward drift, which is in fact what happened. But between the two, gold and TLT, the Chaikin oscillator is much stronger to the upside, as is accumulation, and we have more volume spread analysis accumulation bars. So our outlook for a TLT for the week ahead is to hold long, and we anticipate that TLT could bump against the 142.47 top of the range, or even go beyond it. So we would be holding long TLT for the week. Okay, we're going to take a look at oil as represented by the USO. And our outlook last week was that we could see no reason to be optimistic that oil was turning around. And in fact, we had several successive down days after that. Nothing really much has changed, except there's a little glimmer that maybe the drop in oil could be stabilizing, and that's indicated by the little hookups on the Chaikin oscillator, the accumulation distribution indicator, and the green or white candle at the bottom of the range. However, the Heikin Hashi bars are not indicating that we have any reason to be optimistic. So our outlook for oil for the week ahead would be simply to be prepared to cover your shorts if you're short USO or any of the triple or double or triple oil ETFs, because there is a possibility of at least a bounce. And instead of the dollar, we're going to look at FXY, the Japanese yen. And the yen was really banged around this week by the Bank of Japan and the Prime Minister of Japan, who were bouncing between more helicopter money or just pouring money into the markets themselves. And the yen had quite a boost. I'm going to show you a couple correlation calculators. And let's do the FXY, which is the ETF for the yen, and the SPY. And this calculator measures correlation over 44 trading days, which is about 2 months. And right now there's a low negative correlation between the Japanese yen and the SPY. But we can see throughout the history that it's often been a much higher negative correlation. In other words, when the yen went down, the stock market went up, and when the yen went up, the stock market went down. Well, that correlation was broken this week, and we can see that the yen is going up strongly, and the SPY, or the stock market represented by the SPY, is still drifting northwards. So whether something fundamental has changed, I don't know. If this is temporary or permanent or semi-permanent, we don't know yet. But that correlation has been broken, and I think at a minimum, when something that's been reliable changes, I think that's just a reason for caution, because something's afoot even if we don't understand what it is. The other correlation that we like to look at is between the Japanese yen and gold, and that's a high positive correlation of 78.82%, and that's a high positive, and that has pretty much stayed in place. So when the yen started going higher, we anticipated that the FXY would pull GLD, or the yen pull the gold higher, and that is in fact what happened. But as far as the yen itself is concerned, we can see that the rapid response Chaikin has steepened its incline. The accumulation distribution channel has shifted upwards, and the volume spread analysis indicates accumulation is taking place. So if you're long the yen, we would hold, probably use the low of this particular bar, which is about 93.83, as a stop, because we wouldn't want to be in there if this gap were filled. So I think you want to be looking at the yen in the morning. Unfortunately, it often gaps because of the trading takes place long before the U.S. markets open. But I would be careful of a gap down below this green or white bar and use that as your first cautionary or actual stop in the yen. But other than that, it looks like because of the upward drift in the Ichimoku cloud, that the yen will push up against the top of the trading range. And if we look down on the left-hand side, based on the historical volatility, we can anticipate a high of about 98 over the next 20 days. So if you're long the yen, hold long. Whether you want to get in at this moment in time is a personal choice. We're already well up toward the 1 standard deviation line, and we often will not take a long position if the underlying is between the 1 and 2 standard deviation, because the risk of a not substantial movement from that area is often high. So those are the major asset classes. Looking at them from the week ending July 29th, with hopefully some discernment for what might be happening for the week ahead, beginning August 1st. And we hope you found this useful.